The tech giant Apple is down just 15% since it began that decline at the end of 2021, which now puts them at a market cap of 2.4 trillion US dollars, a PE of 24, and a dividend yield of just less than 1%. And the stock is actually on a 16% rally since last earnings. Although if we look at this from an after hours perspective, we saw an initial 4% decline, but now we've actually recovered a bunch of those losses there. Now we're actually break even after hours. So it's now time to see what happened here by analyzing their Q1 results so that us value investors can better understand this business and determine whether this is a buy or a sell at these levels. So make sure to stick around to the end of the video as we'll answer all those questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. Like we usually do, we're going to go through the fundamentals of the business, the trajectory of this business. We'll take everything into account, and finally we'll end off the video by using our intrinsic value calculator to see where the buying points are for Apple's business. And the last thing we'll do is we'll provide an investment rating for this business. So if you do enjoy this content, make sure to like the video, subscribe. Also make sure to comment your thoughts in the comment section below. And with all that out of the way, let's jump into the analysis. All right, so we're looking at Apple's Q1 fiscal year 2023 results. What have they reported on so far? And well, you can see right away they've missed on both top and bottom line expectations there. You know, a 7-cent miss there on their bottom line, and then a $4.5 billion miss on their revenue expectations. That's actually pretty lofty there. It's actually a 5.5% decline year over year on those revenues. We'll talk more about that in just a second. First, let's talk a little bit about the positives here. They just crossed that 2 billion active device benchmark, which hit an all-time high across its major product categories. Now, if we scroll down here and take a look at this chart produced by Main Street Financial Data, the first link in the description and a great investment resource, we can look at their global active devices. Those have been on the uptrend year over year over year, as you can see. Now we've hit that $2 billion mark. And so obviously that means the demand is still there for their products, you know, hitting all-time high year after year after year. And now they're at over 2 billion active devices with a population of about 8 billion people on the planet. So massive business here. That translates well over to their service subscribers here. Naturally, the more devices they have, the more services they can sell. And so they're at about a 900 million service subscribers here as well. And so once we get down here to our consolidated statement of operations, we can see why the stock was initially down, you know, about 4%. And that's because we look at their products revenue. That's actually down from $104 billion last year down to $96 billion this quarter. That being said, service revenues are up. Altogether, it produced $117 billion worth of net sales, down from $124 billion last year. So again, a decent hit there of about $6 to $7 billion worth on their top line. They were actually able to rake in some of those costs to produce their products there of about $4 billion. So they did have a bit of cost savings here. And by the time we add in our service costs and everything, we have about $50 billion worth of gross margin, you know, down still about $4 billion from last year. And once we deduct for our operating expenses, research, development, selling, general, and admin, you know, we're left with operating expenses here of $14.3 billion. And so that leaves us with about $36 billion worth of operating income here. Again, a $5 billion hit from a year over year perspective. That's not the end of the bad news there. Let's talk a little bit more about the bad news, okay? If we actually look at their net sales by category, their leader amongst all their segments is their iPhones. Those sales are actually down about $6 billion on a year over year basis. Decent hit there, right? Mac sales are down another $3 billion. iPad sales are their only segment actually this quarter that are actually up, and that's about another $2 billion increase there. Wearables are down just slightly, and I want to correct myself, you know, they did have that marginal increase to their service revenues there. But as we saw there, 3 out of the 5 categories here were negatively impacted for Q1 of 2023. Now, while that does sound bad, we have to also take this with a grain of salt because Apple did let us know they did have a lot of supply chain constraints for this quarter. You know, a wide majority of their products and their iPhones are produced over in China. And well, what was happening in China this year, and especially in this last quarter or so, well, they had lockdowns again, still dealing with the impacts of COVID. And so that shut down a lot of their production and they weren't able to ship out iPhones. I was even impacted by this when I ordered my iPhone this last quarter. I had to wait over a month for my iPhone as it was back ordered. And so that did have that negative impact. So take these negative results with a grain of salt because this won't happen every single year. And when they don't have supply chain impacts, we can expect that the revenues will be able to grow. Altogether though, if we look at this Main Street Financial chart here, when we look at the revenue by segment, we can actually see this is the first Q4 in a very long time where they did actually have a decline on a year over year basis. Of course, when I say Q4, I don't want you to be confused. This is the fourth quarter of 2022 that they're reporting on, you know, the December 31st ending period, although they consider this their Q1. So I don't want you to be confused on that, but just understand that they did actually have a year over year decline for the first time in quite a while, at least in this holiday earnings period. So something for investors to keep a watch on and see how they can actually do when they don't have supply chain impacts. Now, in terms of their operating expenses, business as usual, those are going to increase year over year marginally, not by a great lot. And so when we take a look at their gross margins, you can see those are actually relatively stable there. That's at least the bright side, because despite the impairments that they're dealing with this quarter, they're still able to maintain their margins, and that's always what you'd want to see from a business, and probably why the stock actually has rebounded, that 4% after initially falling after hours. Now, if we look at this from a liquidity point of view, they have about $50 billion worth of cash on the balance sheet right now, on $100 billion in long-term debt and $10 billion in short-term. Let's just call it $110 billion in long-term debt. Now, that's a net debt position, but why this is not a concern for myself or most value investors is because if we look at their cash generated from operating the business, just from this quarter alone, they were able to produce $34 billion in cash. Now, they only spent about $3.7 billion of that on capital expenditures, which means they still had about $30 billion worth of free cash flow to reward shareholders just for this quarter alone. As you can see, if you add that up over just 2 quarters, you could already pay off all the debt if they really wanted to. So the debt is not an issue for investors at this current point in time. What did they do though to reward their shareholders? Well, they had some taxes to pay down. They also had a dividend to pay out. Mainly though, their focus is obviously on repurchasing those shares, making those shares more valuable. Their market cap is over $2 trillion worth. So buying back shares isn't a terrible idea at this current point in time, even though they're not at, highly suppressed levels. But other than that, the other thing they're doing down there is paying down some of that debt. So ultimately that leads us with our evaluation of this business. For this quarter, they were able to produce about $36 billion worth of operating income. If we extrapolate that out over the whole year, that equates to about $144 billion worth by the end of 2023. Now, we do have to take these results with a grain of salt, because this is their Q4 holiday season, and so their earnings won't be as lofty as they were for this quarter. And so last year altogether, they had about $120 billion worth of operating income. If we expect that they can do about the same this year, and if we require a 10% return, they do pay a dividend, although it is a little bit small. If we only expect very modest growth here of just 3% over the next decade for Apple on a 24 PE like they're currently trading at, the business should actually be worth about $154 per share. Right now, they're worth $150, which means they're fairly valued if you expect that this business can only grow at 3% for the next decade. Now, if we're looking at this from a more optimistic point of view, let's only assume they can only grow at just 7% for the next 5 years. That drops down to a more stable 4% for the 5 to 10 years after that. On a 30 PE, the stock should be worth over $200 per share, a sizable stock appreciation from where we are currently. And obviously, this would only occur in a very favorable scenario where the global economy rebounds strongly, there's less consumer tightening, etc. Now, in the very worst case scenario, let's assume this business actually declines for the next 5 years at a negative 1% growth rate. Then for the 5 to 10 years after that, they're only growing at about 2% on an 18 PE. The stock would only be worth about $105. I think this is really your margin of safety investment level down there. It's very unlikely that this business will get down to 105. I mean, if we look at the stock price here, it really doesn't like to get below $130. Since 2021, we bounced there once, twice, 3 times now. So to get it down in that low 100s will be a little bit difficult. We're up at $150 right now. So I mean, despite this poor quarter, it will be a challenge to pick up shares at that margin of safety level, especially with this business being the giant that it is, with all of the market's attention on it. So with all that being said, I'm going to give Apple an investment rating of a 6 currently. We can see the mass optimism behind this stock, holding it up. It's only down 15% from those highs back at the end of 2021, like we mentioned earlier, and it keeps getting supported at that $130 level. And so it's not very likely that we'll get down below those levels. Now, if we did and we got closer to $100 per share, of course, my investment rating would change. But at this current point in time, I'll keep it at a 6. I think the investment thesis here is that the lower you buy, the better, of course. Don't expect massive growth from this business at this current point in time. They are maturing, massive business, billions of devices sold. It's one of those ones where you're just expecting it to compound into the future. The risks really here with Apple is that there's some other competitor that comes into the space and starts taking over market share. I think that's also a very low risk scenario where it's not likely to occur. The other risk is that there's just less demand for their products. But of course, one of the moats that they have there is that they have a broad ecosystem from credit cards to TV devices to phones to computers. So they locked you in that ecosystem and you're happy to stay there. And so that's why I think this is a low risk, medium reward type of business. But that's my analysis for today's video. If you've enjoyed it to this point, make sure to leave a like, subscribe, as it really helps out the channel, and also comment your thoughts in the comment section below and start a discussion there. And with all that being said, I'll catch you on the next one.